Hi everybody, welcome to Deep Well Talks of Deepak Academy. When we invest our hard-earned money, we all hope for growth, safety and peace of mind. But the truth is, investment comes with risks. Markets can be unpredictable. Companies may fail. We can manage or reduce this risk by different methods which we have discussed in our previous videos. But not all risks come from markets alone. Sometimes the biggest risk comes from misleading products, unregulated agents or unrealistic promises. That's exactly why we need strong regulation in the financial world. So the role of SEBI or any other regulator is not to limit our opportunities, but to safeguard our confidence as investors from these unethical practices. In India, this vital responsibility is handled by SEBI, the Securities and Exchange Board of India. SEBI acts as a protector of our capital markets. It ensures that companies and intermediaries follow transparent rules, prevents fraud, and protects investors from being taken advantage of. So, as investors, it's important to know who manages our money, how they operate, and what makes each category unique. There are a series of SEBI regulated entities for our investments today, like mutual funds, specialized investment funds, portfolio management services, alternative investment funds, real estate investment trust, infrastructure investment trust, registered investment advisors, and ULIPs, which are partly regulated by SEBI and partly by IRDA. Today, let's get into the details of the time-tested, diversified portfolio managers or fund managers to whom our money is given and is regulated by SEBI, which are nothing but mutual funds, PMS and AIFs. First, let's see mutual funds. Mutual funds are perhaps the most common and trusted way of investing in India. A mutual fund is a pool of money collected from thousands or even millions of investors. This pool is managed by professional fund managers who are experts in analyzing stocks, bonds, and other financial instruments. SEBI regulates all mutual funds under the SEBI Mutual Funds Regulations 1996. Mutual fund managers design different schemes: equity funds, debt funds, hybrid fund, index funds, and many more. They decide where to invest, how much to invest, when to buy securities, or when to sell securities. For example, if you put money in an equity mutual fund, the manager will select a basket of good companies from different sectors like IT, banking, or healthcare, etc. It's useful for investors because diversification. Instead of you buying one or two shares, you get an exposure to a wide range of portfolio. Professional management. You don't have to track markets daily. Transparency. Mutual funds disclose their holdings regularly. So, for an average investor, mutual funds are like traveling in a bus with an experienced driver. The driver is the fund manager. SEBI sets the traffic rules and we reach our destination with many fellow passengers. Now, let's move to portfolio management services. PMS is a more personalized way of managing money. Unlike mutual funds, where all investors' money is pooled together, PMS provides customized portfolios for individuals with high net worth. SEBI regulates PMS under the SEBI Portfolio Managers Regulation 2020. Here, the portfolio manager may create a unique investment strategy for each client. They can buy stocks, bonds, or any other instruments directly in your name. You are the owner of the securities, and the PMS just manages them on your behalf. It's useful for investors because tailored portfolios, unlike mutual funds. You can have a control by putting restrictions at the time of agreement or communicating or dislikes within limits. Transparency. You know exactly which securities are in your account. Active management. PMS managers can take bold calls depending on market movements. But remember, PMS is usually recommended for investors with higher capital, often 50 lakhs or more, since it's a high cost and high service product. Think of PMS as traveling in a taxi instead of a bus. The driver focuses only on you, takes the route you prefer, and ensures you reach your unique destination. Now comes something more sophisticated: alternative investment funds. AIFs are private investment vehicles that pool money from investors but invest in unconventional areas. They go beyond stocks and bonds into areas like private equity, venture capital, hedge funds, real estate, or distressed assets, etc. SEBI regulates AIFs under the SEBI Alternative Investment Regulation 2012. There are three types of AIFs. Category 1 AIF, which invest in startups, small and medium enterprises, social ventures, infrastructures with substantial growth potential. Category 2 AIF invest in debt funds, real estate, equity or debt of unlisted companies that are in the mid or late stage of growth, etc. Category 3 AIFs invest in hedge funds that use complex trading strategies including leveraging and hedging to generate short-term returns and invest predominantly in listed securities. Fund managers here are like explorers. They look for opportunities that are not easily accessible to ordinary investors. For example, they may invest in a young startup that could become the next big organization. Or they may buy into real estate projects. It's useful because of higher potential returns, access to unique opportunities, diversification beyond traditional markets. But of course, AIFs carry higher risk and are available mostly to high net worth investors since the minimum investment start with 1 crore rupees. Think of AIFs as traveling on a private jet. Few people can afford it. It's riskier, but if successful, it can get you a destination unreachable by bus or a taxi. So we have covered a wide range of fund managers today. The common thread across all of them is the SEBI regulation. SEBI ensures that fund managers follow strict rules, disclose information, and act in the best interest of investors. So whether you're a small retail investor or a high net worth individual, there is a SEBI regulated fund manager suited for your needs. The key is to understand your goals, risk appetite, and time horizon before choosing the right vehicle for your investment journey. But even though we have managed to live with the risk of financial markets or unethical practices with these precautions, still we may lose money while investing. It's deeply psychological. Our brains use shortcuts called heuristics to make quick decisions, or we may be biased, which can often mislead us in financial decisions. So in the next video, we can see the reasons for our irrational investment decisions related to our psychology. Thank you.